Hey guys, Dave Silman here. Just another quick video on opportunity funds, qualified opportunity funds by the IRS. And I've already done a video on what they are, how they work briefly, benefits of investing, what investors need to be looking for or investor beware, how to go about investing in one, and where to find these qualified opportunity funds to invest in. And what we're trying to do with this channel is to educate the public as much as we possibly can on these qualified IRS opportunity funds. So let's talk about a illustration of a really good example of what it looks like and the benefit of investing in this qualified opportunity fund. So let's say that you're a taxpayer. You've got an equity position in, I don't know, let's just say Facebook, for example. You bought Facebook stock when it went public. You sold it here recently, and you've got a gain of, or an unrealized gain of, let's say, $2 million, for example. So you sold the stock, you realized the gain, and now you've got this 180 days to decide what are you going to do with it. Are you going to roll that or reinvest that gain into the investment in a qualified opportunity vehicle, qualified opportunity stock, qualified opportunity fund? Rolling that or just the sale of that Facebook stock itself, assuming, I don't know, let's say the taxpayers in a normal tax bracket, 23%, figuring that taxpayer is looking at almost just under, it's a $475,000 gains that he would be responsible for tax on. So that's his tax bill. It's that $476,000 is what he's responsible for cutting a check for to Uncle Sam. So instead, though, the investor reinvests that or rolls that over, an opportunity fund rollover into a qualified opportunity fund, and he did it within that 180-day window. So he put the $475,000 in. 15% of that deferred realized gain will be excluded as property held past the 7-year mark. We kind of touched on those step up in basis, and we're going to do another video a lot more in depth on really what that means as far as a step up in basis, how it works at the 5, 7, 10-year marks in this. The capital gains tax would be due in 2026 on that original deferred gain. So that tax would be right around $400,000, which is the $2 million times the 85% times that 24% tax bracket that he was in, versus not investing. So let's say that he didn't roll that into a qualified opportunity fund. The original, the $475,000, so it's the $2 million times the tax bracket 24%, all right, is what he would end up having to pay for on that gains. There is no tax owed on the $1 million of the post-acquisition appreciation while the gain is reinvested and held in the fund through 2028. That's that 10-year mark. So what does that mean for the investor? It means that there's no taxes on $1 million of the post-acquisition appreciation. So that means that when that fund appreciates in value, there's no tax on that for him. So he got the $475,000 tax saving, and he got that so long as he held that fund through 2028. There's still more guidance that's coming out on these. If you are an investor and you've recently sold and you're looking at or facing a capital gains bill, capital gains tax, you've got 180 days. 180 days from the date that you sold that investment to either roll that into something. If it's personal, if it's property, then it's a 1031A. Now keep in mind that if it's crypto or something like that, you really need to investigate the 1031A guidelines, because they are not the same as what they are for real estate. In addition, if you're looking at or comparing a 1031A versus an opportunity fund, we're going to be doing a video on that here soon, probably sometime in the next, 24, 48 hours. We're going to be just constantly starting to fill up our channel. Find us, subscribe to us, Qualified Opportunity Fund on YouTube. You can find more information out about qualified opportunity funds, how to invest in one, where to invest in one. You can go to either opportunity-funds.com, or if you want to check out a specific fund, take a look at the Sakari Lux Opportunity Fund. That's Sakari Lux, Sakari SakariLuxe.com. Sakari Lux. It's an opportunity fund that is based in Tampa. Looks extremely promising for investors for what they're doing in that area. And Ybor sitting. It's a fund that I've kind of been watching. Full disclosure, it's even a fund that I even actually helped set up. It's one of several that I've helped set up. So, but subscribe to this channel. Keep checking us out for more. We're just kind of starting to get this built out. We intend to be fully ahead of this wave. Answering viewer questions. We're going to be doing some live streaming, some Q&A. Setting up all everything to really kind of be able to get this word out and make sure that we don't have a repeat of what happened with home loan modifications during that program, where a lot of people just took people's money and ran, and then it ruined the whole program. We want to make sure this program really is successful. We see that there could be a lot of good that is done inside of community redevelopment and really just helping out just the environment that we live in. America is really on a really positive growth track right now. We just want to keep that up. And we definitely feel that these qualified opportunity funds, they're an unknown. I mean, you're talking $6.1 trillion of unknown, but huge opportunity for those that get it, and an even better opportunity for the investors that are able to partake in that. So if you've got an investment, again, that 180-day window is important. We're going to be putting up a lot of different tax illustrations, but this is just one quick example. Hope you enjoyed this video. Continue to keep watching our channel. And again, go to SakariLuxe.com, SakariLuxe.com, if you're looking for an opportunity fund. Thanks.